Okay, thanks everyone for joining the team representing BDH Sterling and BDH Tax today as we present you a great session outlining an expat guide to retiring in Australia and tackling the financial pain points. So before we begin, let me just please take you through the general information warning. Presentation today is based on Australian and UK legislation as at 4th of June 2025 and is general information only. It is not tailored advice to your specific situation. So before acting on any of the information contained in today's session, we encourage you to seek tailored advice specific to your needs. My name's Nick Bond. I'm going to be your host today, and I'll also be presenting the second section of today's webinar. I'm one of the and I've worked at BDH Sterling for 15 years. I'm dually licensed and qualified in both the UK and Australia. Joining me today is Alan Collette, who is the Managing Director of BDH Tax. Alan has been a cross-border tax specialist for over 24 years and brings a wealth of knowledge with him today for the webinar. Alan has the tough job today of taking us through the main content you need to know about the major tax considerations for those that are retiring in Australia. And I'll be covering the retirement planning and pension transfer section. So on to the agenda and what we will specifically be covering. So section 1 is expat tax and compliance planning issues. Section 2 is estate planning considerations. Section 3 will cover retirement and income planning. Section 4 will cover a piece about pension transfers. In section 5, we'll have a bit about BDH Sterling and BDH Tax and why you may want to consider using us. And in the last section, we will have allocated time at the end to answer any questions that you may have. Please feel free to type your questions into the Q&A section. We'll try to answer as many as possible. If we don't get through all the questions, we'll come back with any specific answers to the questions that you've asked post the webinar. Please do try and post those questions in the Q&A section that is allocated for that. Okay, so let's get started with the first part of the seminar. Over to you, Alan, for expat tax and compliance planning issues.
That's great. Thank you, Nick. Good morning, good evening, wherever you may be. Thank you for joining us today. So I'm going to start by talking about residency, tax residency. It's key to determining what income is taxable, where it's taxable, and the rules are different in the UK and in Australia. The UK has what's called a statutory residency test, which one must consider in determining whether or not you are a resident of the UK. The statutory residency test was introduced in 2013. So it's been around for some 12 plus years now. We look at primarily number of days in the UK, but there are other factors that determine whether or not you're a resident in the UK under the statutory residency test. In Australia, the tests again have been around a number of years. They're more qualitative in nature. We start by looking at whether you what's called reside in Australia. Are you living in Australia? And the resides test is the one that causes most migrants to become resident in Australia when they move to the country. There are other tests. For example, there's a 183-day test. You can be resident in Australia if you've been there for more than 183 days in a tax year, unless you have a usual place of abode outside Australia. You can be resident if you're domiciled in Australia. We'll come to domicile a bit later. But if you're domiciled in Australia, you're treated as tax resident there unless you have a permanent place of abode elsewhere. And there's what's called a Commonwealth superannuation test, which doesn't affect most people because they're not live members of a Commonwealth superannuation fund. So you can be resident in both countries under their respective residency tests because they have different rules. And in that circumstance, we have to look at the tax treaty. There is a tax treaty between the UK and Australia. And Article 4 of the tax treaty looks at it contains the residency tiebreaker provisions. So, for example, if you find yourself resident in both the UK and Australia, we will ascertain whether or not you have what's called a permanent home in either of the two countries. If you do have a permanent home in, say, Australia, you might let out your UK home and be living in a rented accommodation in Australia. Your permanent home is then in Australia, and under the treaty tiebreaker, you would be resident of Australia. If you've got a permanent home in both or in neither, we then look to what's called your centre of vital interests, and there are various considerations that we must consider in determining whether you're resident under the centre of vital interest test. If your residency can't be determined under that test, we move on to whether you're a citizen of one country and not of the other. If you're a citizen of both, then the relevant taxing authorities, HMRC in the UK and the Australian Tax Office in Australia, then have to reach by mutual agreement, they need to come to a decision about where you're resident. So once we've determined residency, we'll just flick on to the next slide. Residency in one country can cause, for example, pension income to be taxable solely in the jurisdiction in which you are a resident. Article 17 of the UK-Australia Treaty discusses the taxation of pension income. And unlike other sources of income, where income can be taxed in both jurisdictions with a tax credit given for the tax paid in one when it's taxed in the other, with pension income, it is solely taxable in the country in which you are a resident. Now, for those of you who move to Australia and who are in receipt of UK source pension income, there is a process that one goes through because, as I say, under the treaty, the UK doesn't have the right to tax that income. But in the absence of any communication with HMRC, your pension scheme administrator will continue to withhold tax under pay-as-you-earn. So yes, there's a process that one goes through, inevitably some form filling. There's a double tax agreement form that what needs to be completed. The tax office in Australia stamps that form. They provide a certificate of residency, and that is sent off to HMRC, who will then issue a no tax PAYE coding to the payer of the UK pension. The pension is then paid gross. Any tax that has been withheld in the period up to the processing of the form from the time you left the UK and became a resident of Australia is then repaid to you, and you report the pension income on a gross basis to the tax office on an annual tax return. The result of that is that when you submit your tax return in Australia, a tax assessment is issued and you are asked to then make the payment of tax on that income to the ATO. Depending on the amount of the tax that you have to pay in that tax year, you might then enter into what is called the pay-as-you-go instalment system. And the instalment system, broadly speaking, asks you to pay tax on account every 3 months to the tax office. And that tax that you've paid every 3 months through the instalment system is then reported on your tax return for the following year. Credit is given for the tax that you've paid. It's compared with the tax that is due for the year, and there's then a balancing position whereby you either recover, you get tax back from the ATO, or you make an additional payment. And the following year, the instalment amounts are adjusted to reflect the second year's tax return. So just to recap, pension income under the treaty, solely taxable in Australia if you're a resident of Australia, and there's a process which one goes through. And if you need help with all of that, we'll be delighted to support you with it. Rental income, by contrast. So if you move to Australia and you keep your property in the UK, many people will do that. They move to Australia perhaps apply onshore. If they're applying for an onshore parent visa, they'll be granted a bridging visa. They might be applying for a subclass 870 sponsored parent temporary visa. These are visas that have a measure of uncertainty as to outcome, and some people would be looking to retain a home back in the UK, so that they can have a home to go back to in the event that things don't work out. For example, if there's a medical issue that causes the visa application to be unsuccessful, people will look to maybe rent out their home in the UK for a period of time. And in that circumstance, unlike with pension income, the rental income in the UK is first of all taxable in the UK. There aren't sole taxing rights given to rental income. So there would be a need, most probably, to fill in a self-assessment tax return after the end of the UK tax year. UK tax returns are generally due to be submitted by the 31st of January, following the 5th of April year end. If you're lodging the tax return electronically, you retain an entitlement to the UK personal allowance even as a non-resident, so long as you're a UK citizen or indeed an Australian citizen. So you've got an allowance of £12,570 a year before you pay any tax in the UK. But if you do pay, if your net rental income after expenses exceeds that amount, and you do have a liability to pay tax to HMRC, the tax is then creditable against your liability in Australia when it's taxed there. That credit is called a foreign income tax offset and is reported on your Australian tax return. So rental income taxable in both countries, but there are different rules that pertain between the two countries. In Australia, the rules for calculating the net rental income are more generous. You can claim deductions for what are called the capital works. If the property that is being let out is relatively new, built relatively recently, since broadly 1990, you can claim a deduction on your Australian tax return for, in essence, the cost of the construction of the property written off over 40 years. You can claim depreciation deductions for property where you've got fixtures and fitments, for example, white goods in the property that's being let. You can claim depreciation deductions in Australia. You can't do that in the UK as a rule. The UK has also in recent years restricted the deductibility of finance costs, mortgage interest. These days, that the mortgage interest, finance costs are dealt with by way of a tax credit, whereby the amount that you pay during the year multiplied by 20% is a credit against your liability for tax in the year. That change primarily affects those who are paying higher rate tax in the UK. So if you've moved outside the UK, moved to Australia, it's unlikely that the net effect, there's any net effect from the change in the treatment of the mortgage interest. But suffice it to say that the mortgage interest is treated as a tax credit in the UK, and it's treated as a full expense in Australia. So we've talked about residency. We've talked about how being a resident of Australia causes you to be subject to tax in Australia. But the scope of the charge to tax in Australia is limited when you are the holder of a temporary residency visa. Parents, people who are moving to Australia with children in Australia often will look at visa strategies. As mentioned earlier, you might be going to Australia applying onshore for an aged parent visa, or you might be spending some time in Australia as the holder of a subclass 870 sponsored parent temporary visa. These visas are by definition temporary residency visas, and Australia doesn't seek to tax individuals who are resident in Australia holding these types of visa in respect of income that derives from outside Australia. So previous slides talked about rental income being taxable in Australia. It's not if you have a temporary residency visa. You're exempt from tax on such income when you hold such a visa. Similarly, pension income, it's from the UK, has a foreign source. It's not Australian sourced, and therefore it's not taxable while you are holding a temporary residency visa. Capital gains, interestingly, for temporary visa holders, you're not subject to tax in Australia, even if you're living there. If you have a temporary visa and you sell investment assets that are located in the UK or indeed in Australia, so long as they are not what's called taxable Australian property, which in essence is real property in Australia. So there's an opportunity. There's an opportunity for people who are residing in Australia on temporary visas to structure their affairs in such a way as to mitigate their tax position. One could find oneself in a tax advantaged position if you're in Australia on such a visa. One caveat to add to that is that if you have a partner or spouse who's an Australian citizen or permanent resident, that disapplies the temporary resident tax exemption. In that circumstance, if you have an Australian partner or spouse, even though you might be in Australia on a temporary visa, your worldwide income is taxable as if you were a permanent resident or an Australian citizen. This slide talks about remote working. The context of this webinar is retiring to Australia. So this slide, to a large extent, is likely to be redundant. But if you do find yourself continuing to work for a UK employer when you're in Australia, there can be issues. I won't go into any more detail on that particular subject. So tax planning, very important, and it's difficult to plan. It's difficult to plan when you are once you've moved to Australia. It's always best to take advice early, ideally before you go. Compliance-wise, tax return submissions and form completion at an early stage is likely to smooth the path of transition in a tax sense. Timing, property. So, question which we're often asked, where we're often asked to provide some input and to crunch the numbers. Selling property. If you've got investment properties, is it best to sell the property? Say you're moving to Australia, you've got investment properties in the UK. Is it best to sell the properties while you're still in the UK? Or is it best to delay the disposal until after you've left the UK and have moved to Australia? And there are some valuable opportunities that are available to those who have ceased to reside in the UK. So most important, this is a capital gains tax planning point. If you're selling property, you've got the opportunity to rebase the value of the property to its value in April 2015. If you sell the property as a non-resident, this is particularly useful for investment properties that have been acquired, that were acquired some years ago. The opportunity to calculate the capital gain for UK purposes, referencing an April 15 valuation, rather than say the original cost of the property if it was bought in, say, year 2000. You're getting 15 years of tax-free uplift in the reference point in calculating the capital gain if you sell it as a non-resident. And so an understanding of when you cease to be a resident of the UK can be really important in the context of tax planning. If you're letting out your property, earlier on we talked about maybe keeping your main residence in the UK and letting it out. What happens on a future disposal of that property? Let's say you've got maybe an 870 subclass visa and you've applied for a permanent parent visa, and you decide to let out the property in the UK, your main residence, while you're waiting for a decision on a 143 subclass application. In that circumstance, you'll be resident in Australia most probably when you sell the property, not resident in the UK. The UK allows you to treat a former main residence as continuing to be a CGT exempt asset for up to 9 months after you leave. By contrast, in Australia allows you to treat a former main residence as being exempt for up to 6 years. So now that is so long as you don't acquire another property in Australia in the meantime. Recognising, of course, that temporary visa holders moving to Australia are now, since the 1st of April, not allowed to buy property in Australia in their own names, following a legislative change in the run-up to the federal election. If you're renting a property in Australia for a number of years and you're letting out your former main residence in the UK, when the property is eventually sold under Australian rules, you can treat that main residence as continuing to be CGT exempt for up to 6 years. So yes, opportunities. And timing is key, as I say. Right, a few words on estate planning. So, wills. Wills and estates. Who's involved in the administration of a will? Got the deceased person. We've got executors, and we have beneficiaries. The executors are responsible for the administration of the estate of the deceased person. It includes filing any necessary submissions with the tax authorities for the deceased. So if the deceased person was filling in self-assessment tax returns in the UK on a rental property, it's the responsibility of the executors to file those outstanding tax returns with HMRC. And if there are assets owned by the estate of the deceased, which are to be sold to realise value, the realised funds for distribution to the beneficiaries, then it's the responsibility of the executors to deal with the necessary capital gains tax calculations. Tax on death. So Australia doesn't have death duties in the same way as the UK. The UK charges inheritance tax, the scope of which I'll come to in a minute. Australia. So if one dies as a resident of Australia and one's estate is in Australia, and you bequeath those assets to Australian resident beneficiaries, in essence, there's no tax to pay on that, upon the administration of the estate. if one's beneficiaries, if one has a beneficiary located in the UK or elsewhere in the world, they are non-resident beneficiaries. Now that can trigger a liability to capital gains tax because the asset is passing to a non-resident individual. So there's what's called a CGT event can arise when an asset passes to a non-resident beneficiary of an estate, an Australian estate. CGT event K3, I think it is. So when one is structuring one's will in Australia, one would generally look to introduce provisions where a non-resident beneficiary exists or is likely to exist in the future. One would generally look to incorporate or to establish a provision whereby a testamentary trust can be formed upon the death of the individual. In so doing, the assets don't pass to a non-resident beneficiary, they pass to the Australian Resident Testamentary Trust, and you mitigate the CGT event and hence the CGT charge. So in the UK charges inheritance tax, or inheritance tax is within the scope if one dies and has UK-based estate. If you are domiciled up until the 5th of April, if you're domiciled in the UK since the 6th of April, if you are what's called a long-term resident, then your worldwide estate is within the scope of UK inheritance tax. So long-term residency came in on the 6th of April. And broadly speaking, if you've been a resident of the UK in the lead up to departure from the UK, you must be absent from the UK for at least 10 tax years before you escape the worldwide IHT charge, IHT charge on your worldwide assets. So we call it a tail, a long tail. If you leave, let's say you leave the UK this month in June 2025, you've got to be outside the UK for 10 full tax years before your UK-based estate, your worldwide estate, is outside the scope of the charge to UK inheritance tax. So a lot longer than it used to be. A tax year in which you depart, a split year. So again, leaving the UK in this month, June 2025, this year doesn't count. So it's only from the 6th of April 2026, another 10 years. You've got to survive 10 years from the 6th of April 2026 before your worldwide estate is outside the scope of the charge to UK inheritance tax. And there are modifications of this if you haven't been living in the UK for a period of time leading up to your departure. We have got a tax fact sheet on this. So if anyone is interested in receiving our fact sheet that discusses this more fully, please let us know. If you need some advice about structuring your estate, wills planning, we'll be delighted to work with you. This slide here talks about some transitional rules. As I say, take advice from us or whoever your advisor is. It's important. What the difference between IHT on your worldwide estate and just your UK estate can be significant. IHT charged at 40%. So just a few exemptions to talk about under UK IHT rules. Assets passing to a surviving spouse are free from IHT so long as the surviving spouse is a long-term resident of the UK. Unused rate bands can be transferred to surviving spouses for consideration on second death. Gifts reliefs. So if you give money to a child, survives 7 years, that gift falls outside the scope of the charge to UK inheritance tax. There's a sliding scale if you survive more than 3 years but less than 7. Different percentages of the gift are added back into one's estate for the purpose of calculating the IHT position. Last dot point here talks about gifting funds to a relative in Australia. So, as I mentioned earlier, in the context of temporary residents buying property in Australia, it's no longer possible since the 1st of April for temporary residents to buy property, to buy an established property in Australia. Some people will look to maybe gift money to the child, to family members who are residing in Australia to acquire a property. Advice ought to be taken about that particular transaction to make sure that one isn't falling foul of any anti-avoidance provisions in Australia. But under UK inheritance tax rules, such a gift would be a potentially exempt transfer, and hence surviving 7 years takes that gift outside the scope of UK inheritance tax. Excuse me, wills are jurisdiction specific. So if you've written a will in England and Wales, and you're now living in Australia, and you have Australian-based estate, best practice is to write a will in Australia. Otherwise, the UK will needs to be what's called resealed in order for probate to be obtained in Australia, and vice versa. If you've got Australian will, you've got UK assets, it's best to have 2 wills, perhaps, one dealing with the UK-based estate and the other dealing with your Australian estate. That will help your executors with the administration of the estate when the time comes. Otherwise, you're likely to find it's going to take more time and be more costly if you've just got one will that needs to deal with assets in the other jurisdiction. Powers of attorney, a very important lifetime powers of attorney to give the authority, the ability of your trusted, often children, to deal with matters in the event of incapacity. Powers of attorney are generally, as I say, jurisdiction specific. So a power of attorney written in the UK, if you're living in Western Australia, WA, you're likely to find that UK power doesn't have jurisdiction in WA, and therefore you should have power of attorneys prepared in Western Australia. So yeah, powers of attorney and wills generally best dealt with together with a same solicitor, in my view. If you've got family members locally in Australia, have a chat with them if they've got a trusted solicitor. Explore it with them, but I would encourage you to make sure that the solicitor with whom you engage is cognizant of issues such as having non-resident beneficiaries. Often people who are moving or retiring to Australia will have family intended beneficiaries of the estate who aren't residing in Australia. So important that the solicitor understands the international aspects and CGT event K3 potentially arising. And I think that's it for me.
Thanks, Alan. Very informative and very helpful.
Thank you, Nick. I'll turn my slide off and I'll leave it to it. Thank you.
Fantastic. Just before I move on to my section, just a reminder about the Q&A session. If you want us to try and answer the questions during this webinar, please put the questions in the Q&A box, not in the chat, as we won't be able to get to them in the chat. Right. Okay, so on to retirement and income planning. For us to be able to help one with their retirement planning, it is very important to um, understand where one wants to retire. I appreciate that a lot of people do and ah a bit about whether to retire in the UK or whether to retire in Australia. But it does help us with our planning if there is one of the jurisdictions that is of preference. But that said, our advice can also help to determine what may be better, the UK to Australia for your retirement. What do you want to do in retirement? So lots of people have got lots of different things they want to do. It's important to have some goals and objectives. Some people want to go traveling a lot. Some people will want to buy a camper van and go around Australia. Some people will want to go and spend time with family and friends in Europe. Whatever it is you want to do, it's good to have an understanding of what your retirement looks like, because then we're able to map out what income you're going to need in retirement. One question we get all the time is, how much will I need for my retirement? And that is very specific to the individual's goals and objectives and desires. So there's not really a fixed number. The government have an idea of what a family would need, or a couple would need in retirement, but that will be very much based on what the individuals want to do in that time. The money needs to last you, obviously, throughout the length of your retirement. A lot of people will front load their spending, so they'll spend more while they're younger and active, and able to do stuff such as travel around the world. And then as you get older, you'll find you'll spend less and less, and the income need will diminish as you get a bit older. But yeah, if you're interested in looking to get a plan to determine when you can afford to retire, how much you can afford to retire on, it's important to start thinking about all of these aspects. So in terms of cash flow planning, this is in the here and now. So and also during retirement. But how much income do you have coming in from your employment or from super or pensions? And how much are you spending? So what are your mortgage outgoings? What are your basic cost of living outgoings? Do you have any big future commitments, such as a child's university fees, or helping a child to purchase a property in the future? This way we're able to help you manage the cash flow now, but also in retirement, when you may not be earning any income in the future. So it's really important to determine what are those priorities, what are your main objectives with your money now and in retirement, and then we're able to provide you with some cash flow forecasts. So yes, this is a slide that shows you what an example of the cash flow forecasting we can do. We can look at the here and now, as I said, but more, or as importantly, we can look to push that forecasting to retirement and beyond. So as you can see with the top scenario, there's a red line there. That would mean that there's a shortfall in that period of time in the latter years of retirement from one's income needs to what one has available to draw down from in retirement. The bottom graph shows a prettier picture, that all the income needs are met throughout retirement. But we can also tweak these projections. We can put what if scenarios in there. So what if you worked two years longer than initially planned, or what if you, instead of wanted $50,000 a year, you wanted $60,000 a year? What if inflation's running at a high level? What if growth isn't as high as it has been in previous years? So we can run a lot of scenarios and make sure that we get to the desired outcome, whatever the future holds. So again, it's important to really understand what you want to spend in retirement and what you're going to need as big outlays for future plans to help children or buy camper vans or whatever it may be. Okay, but these projections will really help give you some comfort and certainly give you a pathway and a strategy to follow to make sure your retirement needs can be met. So pension contribution strategies, yeah, there's obviously different taxation rules between the UK and Australia. In the UK, we get tax relief when we pay into a UK pension. If you've got taxable income to offset it against. And in Australia, it works the other way round. We actually get taxed on concessional contributions on the way in. But then when we retire in Australia, with if you're drawing from a UK pension, that income is taxed when you start drawing on it, apart from an initial 25% that you're allowed to draw out as a tax-free lump sum from a UK perspective. But that tax-free lump sum is actually accessible to tax in Australia if you're a resident there and drawing out from a UK pension. As is the pension income that you draw on a regular basis, that will be accessible to tax in Australia if you're resident there, or in the UK if you're resident there. With super, when you move into retirement phase, it's very nice that on the way out, there's no tax to pay on drawdown or pension income from a superannuation scheme. So there's distinct advantages of having accrued or accruing a UK pension, and then if you're going to retire in Australia, having accrued that in the UK, transferring it over to an Australian superannuation fund. Okay, so yeah, broadly speaking, with retirement income, we may have different sources from where that income is coming from. Some of you will have UK state pension entitlement, for example. Some will have pension schemes that you're drawing down from the UK that may not be able to be transferred to Australia. You might have rental properties, as Alan spoke about earlier, either in the UK or in Australia. You might have cash in the bank. Whatever it is, we need to identify where all that income is coming from, because then we can look to try and make it as tax efficient as possible when we're looking at that future cash flow forecasting and income drawdown strategy. The way you may be doing it now might be working currently, but it might not be the best bet when you get into retirement phase, such as if anyone's got a rental property that they negatively gear, great when you're a taxpayer, and particularly a high rate taxpayer, but much less benefit when you're in retirement and don't have that income. So yeah, different income sources will have different tax outcomes, and we may be able to help restructure to give you the best tax outcome during your retirement. So yeah, on to a bit more detail on the state pension and the Australian age pension. They're both inflation linked, and they are paid by the government. The UK, what you should do is check your UK state pension entitlement. You need to have 35 qualifying UK years to reach the maximum UK state pension. It's inflation linked until you start drawing at state pension at, say, age 67. Once you start drawing it, if you're living in Australia, that inflation link ceases, which is important to note. So the value of that state pension does diminish over time. You might be able to delay the state pension for a period of time if you're still going to work when you're able to draw the state pension. So that's something that can be looked at. But it's really important to understand what you've entitled to. In terms of the Australian age pension, that is asset tested and means tested. So again, once we know what assets you've got and what income you're likely to have in retirement, we can then project if and when you'll be entitled to get some of the age pension as well. You can get both the UK state pension and the age pension. The age pension is then, if you're drawing the full UK state pension, the age pension, you'll fall down a bit on the income test, so you get a bit less than you would if you didn't have that UK state pension. But having both is certainly a good thing to have, a guaranteed income, which is a lot to be said for having that if you can have it. Okay, on to the pension transfer piece for those of you that have still got pensions in the UK. So firstly, in order to be able to transfer a UK pension, it's got to go into a QROPS, Qualifying Recognised Overseas Pension Scheme. It's known as a ROPS, but a lot of people still familiar with the term QROPS. QROPS were introduced in April 2006, and an overseas pension scheme must meet certain criteria laid out by HMRC in order for it to become a QROPS scheme. So the QROPS is a great option for those that have got UK pension and have left the UK pension permanently and are looking to retire overseas. And in this instance, obviously, Australia. So what are the benefits of transferring to a QROPS? Rather than leaving your UK pension where it is and in the UK, you're able to move that pension fund into an Australian superannuation fund that is a QROPS. So you haven't got to worry about to liaise with the UK scheme. You can have it in the jurisdiction that you're residing in and retiring in. You can have the pension paid in pounds or in Aussie dollars, but if you're living in Australia, most people it will make sense to have that income in Australian dollars. The death benefits are better predominantly in Australia from a super fund or a QROPS fund. 100% of your benefit can pass to your dependent if you pass away tax-free, regardless of your age. That's if it's a spouse that you are financially dependent upon one another, but you can also leave it to children as well, with less tax than you'd probably have to pay if it were coming from a UK pension scheme and the individual was over the age of 75. The tax is not particularly punitive from an Australian super if you're leaving it to kids rather than a spouse. And yes, UK and Australian pensions or supers can be consolidated into one fund. So you can move your UK pension into a QROPS, and you can also then look at moving your Australian super that you've accrued one from working in Australia. That can also be moved into a QROPS if it's the right thing to do, if it's in your best interest to do it. Some people like having all of their pension or super funds in one place, which makes for a bit of easier life on the administration side of things. QROPS responsibilities. So the HMRC is good, or the UK government are good enough to let you transfer your UK pension, but there are some stipulations that are put in place by HMRC. That is that the QROPS has reporting requirements. So that QROPS scheme has to report for 10 years from the date of the transfer. The QROPS fund must provide benefits that are broadly in line with the UK pension scheme. So, for example, you cannot buy residential property in a UK pension fund, and likewise, you can't buy residential property in an Australian QROPS super fund with that UK derived money. So they're trying to make sure that you're not getting a better benefit by transferring than you would if you were to keep it in the UK. There's also a restriction on borrowing. You can only borrow up to 50% of the fund value of the QROPS fund, whereas in a non-QROPS Australian scheme, you can borrow 100% of what you've got in that fund if the bank lend it to you. Also, members must comply with the member payment provision period. Um, this is important to make sure that there's no unauthorized payments, because there can be pretty hefty tax liabilities if there are unauthorized payments. And for example, that member payment provision period, if you've been outside of the UK for 10 years or more, and you move your money into a CureOps fund today, you've still got to keep it in that CureOps fund 5 complete UK tax years before you could roll it out to a non-CureOps fund. If you meet condition of release in Australia, but the 5-year period does not prohibit you from drawing on it, but it does prohibit you from moving it to a non-CureOps superannuation fund. And that CureOps scheme must report trigger events, of which there's 6 or 7, back to HMRC within a prescribed time period. Currently, there are only 2 CureOps options in Australia. There is one retail fund, which is public, open to the public, anyone over the age of 55. The age limit is 28, up to age 57, but is currently 55. The other option is to establish a self-managed super fund that can apply for CureOps status to HMRC. Same rules apply to both. There's reporting requirements. Again, the benefits got to be broadly in line with the UK scheme, and you've got to be mindful of that member provision period, whether you're in the retail fund or whether you're in the self-managed super fund. What types of pensions can be transferred? So UK company pensions, you might know them as defined benefit schemes or final salary schemes. UK defined contribution schemes, SIPs or personal pensions, you might be more familiar with them as that. UK funded public sector schemes. So local government is an example of one of those funded public sector schemes. CureOps that you might have in another jurisdiction. Some people have CureOps funds in Malta, Gibraltar, for example. They can be transferred. And not so common, QNUPs, they can also be transferred to a CureOps. What can't be transferred? The UK state pension. You can draw on that pension, but you will never be able to get the capital value of it from the Department of Work and Pensions. You will simply be able to draw down on it. They'll pay you the income monthly, quarterly, or annually, however you choose to be paid, but you will never be able to ask for a transfer value of the capital value of that state pension. Government unfunded pensions such as the NHS, Army, Police, Fire Service, there's quite a big list. They cannot be transferred. That was stopped in 2015 by the government. Any defined benefit schemes or final salary schemes that are in the pension protection fund, once they go in there, unfortunately, they are not able to be transferred, but they have gone in there for a reason, and they're protected by the rules that are in place with the pension protection fund, which is underpinned by the UK government. Any annuities that have been bought and are in payment, those annuities, you can't commute that pension income back to, or annuity income back to a lump sum. That will remain to be paid out. Why transferring your pension might not be suitable or the best option? So with a defined benefit scheme, as you're probably aware, there's lots of there's good guarantees within that, within those pension funds. So the FCA, the Financial Conduct Authority, have started. They start with the assumption that a transfer out of a defined benefit scheme is not suitable. It's not always cost effective to seek the advice. For example, if you've got a transfer value of £40,000 and you're looking to transfer it out, there's quite a reasonable amount of cost involved in getting the advice that you require to move it. So it's not always cost effective, and sometimes it's not tax effective. You may not have any other income sources in your retirement. So if you've only got the defined benefit income, you might be able to draw on that tax-free both the UK and Australia. So we always look at the tax position. Your current scheme might be providing you with good returns, or some schemes have fixed returns, and it might be difficult to replicate that in an Australian fund. Some schemes have early exit penalties, and some schemes have market value reductions depending on market at the time when one wants to transfer. So it might not be worth incurring these penalties to move it across. Particularly for defined benefit schemes, if you're not comfortable taking risk and investing proceeds from that defined benefit scheme, some payout, then you might be better off staying in the scheme. If you don't want to put the market and you'd rather have it in something secure, then it's probably not much better than having that defined benefit income paid to you. Why consider currencies are a big thing. You can see from that graph the ups and downs. I've seen lots of different exchange rates over the years. When I first arrived in Australia, pound was by $1.45. A couple of years later, I was fortunate enough to be able to experience it being around at $2.20. It came along, went down to $1.60. Point being, it's fluctuates hugely depending on market conditions in the UK, not just market conditions, but government conditions, fiscal policy, etc., can really affect what happens with exchange rates. Be what happens both in the UK and Australia, and other countries like the US, what they do with interest rates, China, how their economy is performing. So there's many different factors that affect the exchange rate. So our advice is get it into dollars, draw down in currency that you're going to be spending the majority of your money in, take that currency risk out. Estate tax. So as I touched on earlier, tax implications if you pass away over the age of 75, pension, the beneficiaries are taxed on income, whether it be income or whether it's a lump sum. Whereas in Australia, it's much more favourably taxed and potentially zero tax if you're passing it on to a spouse. Investment control. You can still maintain investment control in the UK, but if you're in dollars or want to be in dollars, you want to be investing in markets that are available in dollars, such as the Australian market to keep up with Australian inflation. So it does give you a bit more control, but look, it's not insurmountable if you want to keep the fund in the UK and having it invested in Aussie dollars as well. Tax treatment. So income, as I said, income from a superannuation, pension income from a superannuation fund is tax-free. Whereas if you draw income from a UK pension, it's going to be assessable to tax. When you transfer from a UK pension to an Australian super fund, you only pay tax on the growth of the fund from when you arrived in Australia to when the fund arrives in Australia. So hit your date of arrival versus the value of the fund when it's transferred, you only pay tax on that 15%, which in a lot of cases can be a far lower tax rate I might pay if you're drawing it down from a UK pension and paying marginal tax rates for the rest of your life. You're also then able to consolidate your pensions. So rather than having a number of different UK pension funds or Australian pension funds, you can consolidate them and have them all in one place, which does make life a lot easier, particularly as you get a bit older and things get a bit harder, technology and such like. So yes, tax on the pensions are deeper. The income is taxed in Australia at your marginal tax rates, as Alan mentioned a compensation agreement form that can be completed in order for you to be assessed on the tax in Australia. So it can be paid from the UK. From the UK pension fund, you're able to take 25% as a lump sum tax-free. But again, any growth that's achieved on that fund is then apportionable to the sum as well. So the lump sum is tax-free from the perspective, but it's taxable from Australian perspective. And lump sums, depending on how they're taken, outside of the 25% tax-free cash, lump sums can also, if you're drawing down lump sum in the incorrect way. As I mentioned, the growth of the fund from your date of arrival in Australia is taxed at 15%, and it's paid by the super fund receipt of the fund's landing. There's a form you need to complete to self-assess to say that amount of the fund that's been transferred is growth, and the rest will be a non-concessional component. We need to be mindful of the non-concessional caps. So the non-concessional cap is $120,000 per person per year, but there's something called the bring forward provision that allows you to bring $360,000 in every 3 years. Transfer options under age 55. Look, you can't move it to Australia until you're 55, but there are things you can do, such as consolidating it into a SIP or another private pension in the UK. You might be able to buy dollars and invest in dollars in that SIP as well, which is the next best option to being able to have a Australian superannuation fund whilst you're waiting for to reach the age of 55 or 57, as it will be in 2028. Or you can leave it where it is and do nothing with it until you reach the age to transfer. What's the benefits of a UK SIP? So the self-invested personal pension, largely the benefits that we use it for is that you can buy and convert into Australian dollars or keep it in pounds, and it can be invested in pounds or dollars as well. But with the exchange rate as strong as it is at the moment, we're finding a lot of people are keen to convert that UK pension into Australian dollars as soon as possible. If you pass away under the age of 75 and you've got a UK pension, the benefits can be passed over to your beneficiary tax-free. As I mentioned earlier, if you pass away over 75, there are tax implications. And with a SIP, you can have as much input into the investment of your pension as you wish, or as little as you wish, and have someone like us help you with that investment. But they're, as the title would suggest, self-invested personal pensions, they're quite flexible in what you can invest in. So the transfer process, how does that look? Initially, you would contact us for an initial meeting. We don't charge for that meeting, and during that call or meeting, we will be able to ascertain whether or not it's going to be beneficial for you to work with us. We'll be honest. If it's not going to give you a benefit, then we will certainly be upfront about that. But it's no cost for the initial meeting where we can scope out what we think is the right way to help you. Then once we've had that meeting and you've decided whether or not you wish to proceed, we will then produce a pension transfer report for you, and we will determine whether or not we believe it is in your best interest to transfer those funds across. We'll give you all the do's and don'ts, whys and why nots. We'll do all the tax calculations and provide you with a valuable document that will allow you to make an informed decision on whether or not you want to transfer. We will make our recommendation of what we think is in your best interest, but ultimately it's your money, it's your choice of what you want to do with it. Then following the report, if the advice is to transfer and you wish to follow that advice, then we can help with the implementation of getting that money across. For some people, it's not too complicated, but those with larger funds that are over that non-concessional cap limit of 360, there sometimes has to be a staggered year approach to getting it across. But we can help with all of that. Why should you seek advice before you make a decision? I often get people coming to me that have done stuff without having advice. Sometimes it's too late and it doesn't leave the option of transferring, for example. Sometimes they've done something that will give them a much bigger tax consequence than if they'd had advice first and perhaps done it in a slightly different way. If you do things incorrectly with the cure-up side of things, penalties of up to 55% may apply for non-compliant transfers. And also, we can also confirm pretty quickly with you if the pension can or can't be transferred to Australia. Okay, on to the section 5. So just a bit about BDH tax and why you should look to use them. BDH is a regulated firm of tax agents with offices in the UK and Australia. They specialise in delivering tax solutions in the UK and in Australia for individuals who are moving to Australia or who are already living in one country and have tax issues to deal with in the other. So I've worked with Alan for many, many years. He and his team are great. Alan will also have an initial meeting with you to ascertain whether there's work to be done or may not need any help. But you can contact BDH Tax at bdhtax.com, email at tax@bdhtax.com, and there's the phone numbers for the offices, but just look them up on Google and you'll be able to get to be able to book an appointment or make a phone call to them. BDH Sterling. So we are chartered financial planning firm in the UK, which is the highest distinction financial planning firm can have. We have dual licensed advisors in both jurisdictions that with the permissions to provide pension transfer advice and importantly defined benefit advice, because there is quite strict rules around who can give that advice, but we can. We have 15 years of experience in pension transfers, and we provide our advice in-house. We don't outsource anything. All the advice that you receive is from us, not from a third party. And not only do we do the pension transfer stuff, but as I talked about earlier, we're holistic financial planners. We can help with building a plan to get you to your retirement goals and also to help you continue enjoying your retirement and beyond. So if you want to speak to us, please email inquiries at BDH Sterling and we will get back to you as soon as we can, and you will be able to book in an appointment to speak to one of us. It'd be great if you can give a bit of a background into what it is you want help with and broadly what your asset base is or pension funds are or retirement planning needs are. That would be great. Right, on to the Q&A now. It's time to answer some of the questions that have come through. So if you haven't asked one yet, but you want to, please pop that into the Q&A section and we'll try to answer as many as possible. We've got about another 20 minutes and we've got, I've just seen 65 questions on the board, so I don't think we'll get through them all. Yeah, I saw that just out the corner of my eye. So I'll let Alan kick off with a couple and then I'll jump in and then, yeah, let's see where we get to.
Excellent. Thank you, Nick. That's great. All right, so I'm just going to read out some of the questions of a tax nature, and I'll try to answer them. When is the pension declared on the Australian tax return? Is it when it's paid by HMRC or when it is transferred to Australia? It's taxable in Australia when it's received by you. So whether it's If you receive it in a UK bank account, that's when it's taxable in Australia. It's not when it's received in Australia. So it doesn't work on what's called a remittance basis. It's on a rising basis. When are you entitled to receive it? When have you received it? That's when it's taxable in Australia, given that you're taxable in Australia on your worldwide income. If you are a resident in Australia, bear with me. If you're a resident in Australia and you dispose of a rental property or properties in the UK, what happens about CGT? So if you're residing in Australia and you're subject to tax in Australia on your worldwide income and capital gains, i.e. you're a permanent resident or citizen who's a resident of Australia, first of all, we calculate the capital gain in the UK under UK rules. If you're not resident in the UK, we've got the options available that I mentioned earlier, including the rebasing to 6th of April 2015, given you owned the property at that time or prior. Calculate the capital gain in the UK first. There is a compliance regime in the UK that sits around the disposal of such properties. You have a requirement to submit a non-resident CGT return within 60 days of the sale completing, and you have to pay any tax owing within that same timeline. If you're late, you'll find yourself with late filing penalties in respect to the return and interest costs in respect to the late paid tax. So UK first, Australia, we then look at the position in Australia, we calculate the gain under Australian rules, and we claim a tax offset, a tax credit for UK tax. It's usually the case that in Australia we claim a tax credit for 50% of the UK tax. So just to recap, 50% of the UK tax is usually creditable against the Australian liability. The reason it's 50% is because in Australia, you're allowed to claim a CGT discount if you have owned an asset for more than 12 months since the asset became within the scope of Australian CGT. So the tax office says if you're claiming the 50% CGT discount, you can only have 50% of the foreign tax as an offset to reduce your liability in Australia. So the two need to be taken together. Often people will ask us to run those calculations so that they can see what they're left with if they decide to sell a residential property in the UK when they're residing in Australia. Long answer to a short question.
Do you want me to do one now, Alan?
Go for it, Nick.
So if we had a private UK pension that allows for a tax-free lump sum payment in the UK, as we live in Australia, would we still be entitled to that lump sum being tax-free? No, unfortunately not. The lump sum, the tax-free lump sum, tax-free in the UK, as it says, but the growth of that fund since you arrived in Australia to the time that you take that lump sum, that growth is assessable to tax at your marginal rate, unless, of course, you're, as Alan mentioned, a temporary resident. But if you're a permanent resident citizen, then you will be paying tax on that lump sum from that UK pension scheme. Okay, let me just.
Take one, Nick?
Yeah, you take one. Yep.
Okay. At what point do we need to submit forms for dual taxation? Is it once you have permanent residency visas or while we're still on temporary residency visas? I'm assuming here that we're talking about the double tax agreement forms in respect of pension income. Pension income received from the UK received by individuals who are temporary residents, temporary visa holders, not taxable in Australia. Therefore, that the need to submit that form doesn't arise. The pension income remains taxable in the UK under pay as you earn. It's only once you can no longer rely upon the temporary resident exemptions that the pension income becomes taxable solely in Australia under Article 17, and that's when you fill in the double tax agreement forms. I hope that's what the question's referring to.
I'll jump in now, Alan. I've got one to answer. Is it possible to transfer a SIP, which is in drawdown from the UK to Australia? Specifically, I've taken my full tax-free cash lump sum, but I've not drawn any taxable income from the SIP. and don't intend to do so at the current time. Short answer is yes. Long answer is it can be a bit protracted, depending on what SIP it is, who it's with. There are quite strict rules around partial transfers from crystallized fund, i.e. you've taken the tax-free cash, so it's crystallized. And we do have a method to do it, but we would certainly have to more than likely have to move it from the current SIP in which it's in. But yes, short answer is yes, we can help with that. I'll just jump in and answer the next one as well, Alan. Can BDH Sterling help with pension transfers and combining funds, etc.? Yes, absolutely. That's bread and butter for us, the pension transfer side of things, and consolidating pension funds, whether it be in the UK or in Australia. Absolutely.
Okay. A question. I'm going on a 143 subclass visa, contributory parent. Do I only have 9 months after selling UK property, or if money goes to Oz, do I have 6 years? So the capital gains event is the sale of the property. So if you sell a main residence before you go to Australia, it's exempt from CGT. If you sell a property in the UK after you've left, it needs to be sold within 9 months in order for it to be CGT exempt under UK rules. So if you leave the property vacant, you've got 9 months in which to sell it. And indeed, that pertains whether or not you're a resident in the UK. If you've sold it within 9 months, then there's no Australian CGT. As I mentioned earlier, you're allowed to treat a former main residence as being CGT exempt for up to 6 years under Australian rules. But it's the disposal of the property that is the CGT event. Some people ask about the transferring of the funds to Australia, and that isn't the taxable transaction. The transaction that gives the CGT risk is the sale of the property, not the transfer of funds.
I'll jump in and answer one, Alan. Is there tax on growth in Australian superannuation fund pre-post retirement drawdown? So there is tax in accumulation phase in Australian super. So accumulation phase being pre-pension phase, pre-retirement. You pay tax at a maximum rate of 15% on any realised capital gains, but that tax rate can drop to 10% if you've owned those assets for 12 months or longer. Any income, dividends, distributions, interest, that is all taxed at 15% inside of super in the accumulation phase. But once you start drawing on the fund and you start an account-based pension, the internal tax drops to 0. So once you're in retirement phase, 0% tax on any realised gains, dividends, distributions, etc.
Okay. If on an 804 bridging visa, do you have to include UK pension income on your Australian tax return, or only income derived in Australia, such as bank interest? Tax has already been deducted by HMRC in the UK. So a bridging visa, temporary residency visa, the pension income from the UK is not taxable in Australia. It's technically reportable on an Australian tax return if you're required to fill in a tax return. It goes in as what's called target foreign income. So it's technically disclosable, it's not taxable. Now, do you need to fill in an Australian tax return if you're on a bridging visa? Most people, given that your only income that's taxable in Australia if you're on a temporary visa is Australian source income, it might be that the income that you receive from within Australia is less than the tax-free threshold, the tax-free income amount equivalent to the UK personal allowance. I find that people will open a bank account in Australia and they want to receive interest on that from that account on a gross basis. If you don't provide the bank, if you're residing in Australia and you don't provide the bank with a tax file number, the bank will withhold tax at the highest rate from the income you receive. The consequence of applying for a tax file number is that the ATO, the Australian Tax Office, will expect you to file something after the end of the tax year, after the 30th of June. Now, that something can be what's called a non-lodgement advice. Non-lodgement advice is basically a statement, a declaration to say I don't need to, I've got no taxable income, income that's causing me to give rise to a tax liability. In that circumstance, you wouldn't need to report your UK pension income. But if you are completing a tax return, if you say your interest income and other Australian source income causes you to have a tax liability, then you would properly report your pension income as target foreign income, even though it's not taxable. So the pension income continues to be taxable in the UK under pay as you earn while you're on a temporary residency visa.
Okay, thanks, Alan. I'll jump in and do another one. I'm an Australian citizen. I have a private pension in the UK. Can I transfer it to my current Australian super fund, or does it have to go into a specified BDH pension? There are only two QROPS options there. One is the SMSF, one is a retail scheme. It's not a BDH pension or super fund per se. Certainly the retail scheme is completely independent of us. The SMSF, we can help establish that, and that SMSF will be the individual's superannuation fund. It's not a BDH specific fund. But in short, no, you can't move it to your current pension scheme unless it happens to be that retail fund, or it's an SMSF that has already got QROP status. For QROPS, I'll jump in. I've got another one here, Alan. Yeah. For QROPS, we can only transfer the maximum, bring forward 3 years non-concessional caps at $360,000 as of today's limit. However, if we have more than that amount in UK pension, how do we manage to transfer? Are we able to transfer the max limit to QROPS and the rest is withdrawn annually, or is something else possible? So you got the 360 allowance each year that you can do, plus the growth of the fund can come over in excess of that 360 allowance. If you've got a large fund that is in excess of the 360 and the growth being transferred, then it will sit in the UK until your non-concessional cap has refreshed. So basically, you got to wait for 3 years, 3 tax years to expire once you've done that 360, and then you can repeat. You can do the growth, you can do the 360 into the SMSF. For some people, it might be 2, 3, 4 tranches if you've got a large fund, but you can do that up to the age of 65. So from the age of 55 to 75, you've got plenty of time to be able to get that that money over under the non-concessional limits.
Okay, another tax one. Is there capital gains tax when you sell your sole Australian residence to return to the UK? So long as you're resident in Australia, no CGT to pay on the disposal of main residence. The key planning point is to make sure you sell it while you're resident in Australia. If you sell it when you're not resident in Australia, the entire gain over the period of your ownership is subject to tax in Australia at non-resident rates. There was a change in the law on the 1st of July 2020, whereby non-residents and non-Australian residents selling residential property in Australia could no longer access the CGT main residence exemption. So that goes to the question of your residency. Make sure you know when you cease to be a resident of Australia, because you need to time the sale of your property before that takes place.
I've got one, Alan. So is it worth paying extra national insurance contributions to get a full UK state pension if it just reduces the Australian age pension? So where's the cutoff? We don't specifically deal with the UK state pension. We factor it into our projections. we can refer you to a chap who can help the UK state pension. But broadly speaking, you will be better off having full UK state pension and some of the Australian age pension than just having the Australian age pension. So if you can get to the full UK state pension limit, and you'll be able to meet the income or asset test for the age pension, you'll be better off having full UK state and topped up with the age payment. The state pension is no longer index linked, so the value of it diminishes over time. So your age pension entitlement would creep up because your UK state pension effectively would be flat.
Okay. When do you become non-resident for tax in the UK if you apply onshore in Australia for an aged parent visa? So much depends here on when you make your permanent move to Australia. People will often apply for onshore aged parent visas. They'll make a holiday trip to Australia and will apply for their visa on that trip, and then come back to the UK, settle up their affairs, and then make the permanent move out there. In that example, it's when you make the permanent move out there, almost certainly that's when you would cease to be resident in the UK and you'd commence residency in Australia. It's about intention, but underpinning all of that is the statutory residency test that I mentioned earlier. So yeah, doesn't have a great deal of consequence in terms of the taxation of your of the pension income, because if you apply onshore for an aged parent visa, you're going to be a bridging visa holder and you're a temporary resident. So the taxation of your pension income is unchanged, but residency changes when you make the permanent move out to Australia.
Okay, perfect. Is there an age limit to consider if you want to transfer UK pension to Australia? So the earliest you can do it is age 55, as I mentioned before, up to 57 in 2028. And the latest that you can do it is age 75 from a non-concessional contribution perspective. So 55 to 75 is the age requirements. Got another one quickly, Alan, I can do.
Yeah.
After transferring into a QROPS, how long before you can roll it over into an Australian super fund? HMRC financial implications. So it's got to be that a minimum 5 years, the 5 UK tax years, before you can roll out from a QROPS to a non-QROPS fund. But you also would need to have been non-resident for at least 10 years. So if you're fresh to Australia, the answer to that question is going to be the 10 years. If you've been here a long time, then it's the five tax years.
Okay, I'll make this my last one, Nick, because I'm conscious that we're getting close to past. Does the certificate of residency stamped by the ATO mean that my UK state pension is paid gross and taxed only in Australia? Yes, in answer to that question. The state pension is no longer subject to tax in the UK once you are a resident of Australia, given you're not subject to the temporary resident exemptions. You'd pay the tax on your UK state pension in Australia. Just to mention that you can claim in Australia a tax deduction on your Australian tax return equal to 80% of the UK state pension. So effectively only 92% of the UK state pension is taxable. That 8% is the result of an agreement between the UK and Australian governments many years ago. Yeah, taxable solely in Australia with an 8% tax deduction available.
Right, I'll do one more then, Alan, and then I'll wrap it up. Does an adult child resident in Australia count as a dependent in terms of Australian super passing to them upon death? Depends if they are financially dependent on you. If they are working, have their own financial dependence, then no. And if they're over the age of 23 and financially dependent, then it's very, very unlikely or would be impossible for them to be a dependent. It's got to be someone that is you're financially dependent upon one another, not just helping with a bit of the rent, but ultimately that they need you to support them. So yeah, most instances, no, an adult child would not be a dependent. All right, we'll leave the Q&A. We will hope to get back to you in the next 48 hours or so with the recording of this session, and we will endeavour to reach out to you with any specific questions. But please do contact us and book a time to speak to both BDH Tax and BDH Australia to help to see if we'll be able to assist you with your planning needs or tax needs. Please also keep out an eye for a feedback survey that we'll send through. It's just 4 short questions. It comes out at the end of this session and also in the email with your slides. We'd really appreciate getting some feedback from you. And just a reminder for those wanting to contact us, the email address is inquiries@bdhsterling.com. Once again, thanks on behalf of BDH Sterling and BDH Tax for your time and listening and for your questions. Many thanks.
Thank you.